But how big is a factor of all of that if you are a long-term investor? What should you be the areas you should be looking at if you are actually a positional trader? All of that we'll be talking to Abhay Agarwal, who is joining us from Piper Serica as we right now this afternoon. Abhay, good afternoon. You must be observing a lot of news flow. Some of your peers may also call it a lot of noise in the global arena, but it is impacting sentiment a whole lot. What are your readings?
No, I think any kind of geopolitical risk is a major risk for global investors. What we are seeing is that anyway, even large global investors are very skittish right now, very risk averse, because they made very good returns in last calendar year, and people are trying to now protect last year's return by being a little risk averse, getting into cash. So we are not seeing any money go away from the market on a permanent basis. All that has happened is that global funds at a global level, the cash position was 5%. Now it has been increased to 5.3%. But that 0.3% is large enough in terms of outflows, especially from smaller emerging markets like India, that it has impacted the market levels considerably. And now people are trying to read reasons, the Ukraine geopolitical risk, and before that, the Fed rate hike, and prior to that, the Omicron third wave. Were three big reasons. Omicron wave has, tapered down now. The Fed rate hike still, the risk remains elevated for the markets, but still that is factored in. What people are still trying to get around their arms around is what could be the possible outcome and how damaging could it be to global economies and markets if there is a confrontation between Russia and NATO, pretty much. Could it be something bigger? So I think any commentary that comes out that kind of convinces people that, look, this is something that nobody really wants to go to war and it is more of posturing, then I think the same money which went away will come back also pretty fast. That's my personal view.
Abhay, there's a very interesting note by Russell Napier this morning doing the rounds, and that says that there is a case for a strong structural wave of capital coming to India because a lot of risk capital, both in the form of FDI, after what happened, the way China regulated their fintechs, and also by way of FII money because of uncertainty in policy making, may actually come out of China and may look for structural stories. And India has a chance if we project ourselves the right way, both to attract big long-term capital. But actually, in the short term, last 8-9 months, we've seen a big FII outflow. How do you analyze this argument by Russell? And do you believe that can happen? How much probability would you assign?
No, I think it's a very, very, I would say, intelligent and well thought through prognosis. Because, if you look at it, China and India are two very large growth, countries. 1/3 of world's population lives in these two countries, and almost 50% of that population is below, 40 years of age, especially in India. I think global investors, when they look at India and China, frankly, they don't look at them separately. I think it's not a question of whether this or this. It is more like, what are the opportunities in both of them. So China is probably 15 years ahead of India. A lot of money has been made already. China has a market cap of about $20 trillion if you add Hong Kong also to it, whereas India has only $3.5 trillion of market cap. So they are very different in their life cycle stages. So it's not really, they're not really comparable. At the same time, if you're a pure growth international investors, you would prioritize India over China because you will say that, look, $3.5 trillion can become 7 can become 10, and 10 can become 15 faster than 20 can become 30. So from that perspective, yes, we would expect that India, will continue to get very high quality long-term capital from private equity investors, from large corporate investors, as it happened last year and still is happening. The FII flows are more volatile. They are more market sentiment driven. They are more short-term performance driven. So it's very difficult to say, frankly, nobody expected that more than $20 billion will flow out of India from FPI flows. And, at the same time, if those flows reverse and 20 billion comes in, nobody can really estimate it right now. But I think whatever happens to China, I believe that India will continue to get very meaningful flows from for FDI and FII, sooner than later.
Right. Abhay, you also have a very keen eye on consumer tech and technology-enabled businesses, not just legacy IT companies, which seem to be certainly in a good spot. And this space, which has got a variety of options now in the listed space, not only the recent Nykas and Paytm and Policy Bazaar which got listed, but a variety of other stocks, Rate Gains, Map My India, Affle variety. Now, there has been clearly some amount of shrinking in the multiples which the market was assigning to this side of the market. Do you think that that kind of shrinking of multiple is over and there is a case to relook and that area has got healthier, or do you think it may remain under pressure a little more?
I think, Ajay, what we are seeing not only in India but globally is that high growth stocks which kind of traded up beyond their fair value. And we have looked at pretty much every company that has listed in last couple of years that uses technology as for its core business, whether it's Affle or RateGain or Route Mobile or Angel Broking or Paytm, Zomato variety. And I think it is not correct to actually brush them all with the same paint, because some of them have very strong unit level economics, profitable unit level economics, which is a starting point when we look at these businesses. Whereas some of them are still struggling with unit level profitability itself. So I don't think after this correction, the companies that are struggling with their business models, they will see a rebound. Whereas companies that have got beaten down just because they are part of the so-called tech sector, but have very, very strong fundamental unit level economics like a Zomato or Nykaa, I think they would still bounce back, because then the bet that investors are going to make is that will the GMV and AOV will grow at a rate of 30 to 40% or 50% year on year for next 3-4 years for these companies to become wildly profitable and cash flow positive. So I think not all, but some of these companies will bounce back and will reward their shareholders handsomely. But the investors will have to do the hard work of figuring out which companies do they want to bet on.
Right. Lastly, before I let you go, Abhay, give us a flavor of what kind of changes or amendments have you been on the margin making as far as your own portfolio is concerned?
Yeah, so I think, Ajay, what we are doing is we have recently removed some stocks from the portfolio that we believe that there is the near-term growth will be challenged for next couple of years. So this is some insurance stocks, an exchange stock, and we have added, Divis Lab to our portfolio, which we believe is getting into a stronger and stronger space. We are also looking to add some small mid-cap travel stocks, because we are seeing a significant rebound in travel activity taking place. But the bet will be on those travel companies that are using technology to improve their processes, become faster and cheaper and more profitable as the demand comes up.
Right. All right, Abhay, we'll let you go on that one. Thanks so much for dropping by today to share your thoughts on the market. That was Abhay Agarwal of Piper Serica.